Okay, so I think we are live now. So good evening, everyone, and thank you for joining me today. Today, the agenda will be that we will be looking at how we can use the trap indicator. I'll explain what the trap indicator is for positional options buying. So, from a buyer's perspective, if you want to buy options, and there's nothing that one should be an option buyer or an option seller. I feel that one should be an opportunist. So wherever there is a possibility that you can make money from buying options, obviously one should be looking at opportunities like that as well. So from a buyer's perspective, today is what we'll talk about. Last time we did discuss about option writing as well. So if you are more interested in option writing, maybe you can watch the last webinar that we did. But this time, from a buyer's perspective, we will try to understand that if I want to buy options positionally, then how I can use the Quantsapp trap indicator and imply trades from there and convert it into buying opportunities. So before I get into explaining what the trap indicator is and how we can go and convert that into a trade, let me first explain you where this concept originates from, that in buying options. So as we know that if you are an options buyer, you can make money. So if, let's say, derivative is a zero sum game, so many people might argue that it is not a zero sum game because you might have underlying holding also. But as we know that most of the volume that happens in the market is speculative in nature, which basically means that if somebody is buying, somebody is selling, which again means that if somebody is making profit, then somebody else is making losses, right? So in derivatives, if you are making money, somebody is losing money. That is mostly the case, minus some trades that might be sold against the underlying holding. That is possible, but majority of the trade, if you see, is that somebody is making money and someone else is losing money. So if you think it from a buyer's perspective, that when will be that scenario that buyers are making money? For buyers to make money, sellers have to lose money. And if I am just an option buyer and if I want to make money from option buying, I need to identify scenarios when sellers will start losing big time money, right? So as we know that most of the time, option writers, when I say most of the time, we know what the strike rate is. About 65% of the time, option writers will tend to make money because the market will obviously be within a consolidation and within the market's expected range, which I explained in detail in the last webinar, right? So the market will be kind of oscillating within the expected range, and only 35% of the time you will see that the market will go beyond that, right? So from a buyer's perspective, 35% is the probability that the market is going to outperform the market's own expectation. And that is what makes it a very low strike game, right? That you will have to be very choosy that when should I be buying options. But that is not the case with selling options, because even if you go and randomly sell options, you have a 65% strike rate. But what happens is, it's not that just having a 65% strike rate with the sellers will give them an edge to go and make money. Because in that 65% of the time that they are going right, they will make very small profits. And in the remaining 35% of the time, when they are losing money, they will lose more, right? And similarly, from a buyer's perspective, what will happen is that when sellers are losing big money, is the opportunity for option buyers, if you can identify those kind of an opportunities, that when are sellers going to lose big money, and if I can identify that and go and take a trade, that is what will make the buyer profitable, right? So if I summarize what I just said, is that as an option buyer, I need to go and find opportunities of when will option writers lose. If I can identify that, then I can be more profitable in my trades. So let me share my screen, and I'll start with a very basic concept of open interest first of all. Or I'm sure that if you're using Quantsapp, then everybody must have used this tool, which is open interest, and otherwise elsewhere also you might have seen a lot of open interest chart. But the way I look at, so this way of representation of open interest is a copyright of Quantsapp, and I like the way of how this chart directly shows you open interest. So let me just show you that what is the concept that we are getting into, so that it gives you some idea of what we are trying to achieve. So if you look at this open interest chart of Nifty, right? So what we have done is that we have plotted the weekly expiry. So if you see, it is Nifty 11th August expiry, and we have plotted the open interest chart for the weekly option. In this case, what you can see is, so let me zoom it slightly. Okay, so if you see that these are the call writers, the green bars that you see on the upside are basically the call writers, and on the downside you see a lot of red bars, and that's are basically the puts, right? So the greens are the calls and the reds are the puts. And in that, if I zoom it a bit more just to see what is happening inside, so you can see, if I look at this open interest chart, it tells me that this strike, which is 17,700 strike, has added this much open interest, right? So you can see that there's a deep green color, which basically indicates that there is an addition that has happened today. So today what we can see is that 17,700 call option on Nifty has added a lot of open interest, which basically means that more people have come to sell this option. And similarly, if you see the next liquid strike, that is 17,800, even that has added a lot of call option, right? But on the other side, if you see for the puts, 17,500 has added some OI. And this hollow sign that you see, where you see that there's a red bar and then a hollow red bar, right? So inside this is where the reduction has happened. So what happens is that if you open interest data is no secret, everybody has it available, and the exchange keeps reporting it. It is not real time from the exchange, but it comes. I don't know what the exact time frame is, because sometimes I do see that some open interest comes in 30 seconds, sometimes it comes in 1 minute, all the way up to 3 minutes. But basically, the open interest data is same for all the market participants, and whenever the exchange sends it, then this is available to all. And this tells that, where the open interest addition or reductions are happening. So if you look at this chart, you can clearly see that majority of the call writers, or the highest call open interest, is right now at 18,000, which means that at the level of 18,000, a lot of call options are sold. So if I just remove this legend slightly, you can see that 18,000 call option is the heaviest call option which has been sold. Why we are saying sold? Because there's a significant amount of OI, and who is in control? The sellers are in control, because that's a very big quantum of open interest that we have. Obviously, someone has bought it, but that might be a strategy position, or maybe somebody is trying to buy a lottery ticket. But who is in control? The sellers are in control, because the 18,000 call option is not trapped, and they are making money from the theta decay as of now, because the market is far beyond that level, right? So if you look at all the strikes on the upside, you can consistently see that at every 100 point, you can see that there are significant amount of open interest on the call side as well as on the put side. But when the market is significantly trending in nature, then what happens is, and even if I look within this data, it is very difficult for me to understand whether sellers are trapped. So let me explain you how will we know, first of all, or how will the data or the model that we have built will know that there's a trap. So what happens is that, let me give you a very simple case. In this case, we are looking at Nifty. We'll try and see Bank Nifty also, if I can get a very exact case to explain. But basically, if you look at this open interest of 17,400, right? So you can see at 17,400, I'm talking about this strike. Let me zoom this so that you can see it very clearly. If you look at the strike of 17,400 call option, when the market was trading below 17,400, what do you think was the open interest chart looking like? Obviously, it would have been looking like something like this, where a significant amount of open interest might have been on the upside when the market did not reach 17,400. But now, because the market has reached beyond 17,400, what is happening is that you see that in this strike, there is a lot of open interest reduction that is happening. And these call writers are now trapped, and they are shifting their position, where if you see in 17,500, there is a open interest addition. Even at 17,600, there's an open interest addition. So what is happening inside this open interest data? Maybe sometime I will try to do a webinar specifically on open interest if that could be of area of interest for the people, right? But if I just look at this data right now, and if I read it very properly, a lot of people look at the data on the upside, that whether the call writers on the upside are trapped or not. But if you go slightly historically, right, and if you try to understand what is happening within the data, right now maybe 17,600 is a good call open interest. But some days back, a few days back, when the market did not reach to that level, then even 17,400 was significant, right? People sold the 17,400 call option. But why don't you see that open interest in call now? Because those people were already trapped. And what they did eventually is that they will square off that calls that were sold and they are trapped into, and they will shift their position to 17,500 or 600. What will happen if the market keeps going up? Will 17,600 be the same OI? It will not. You'll again see that 17,000, let's say if I'm saying that if the market goes to 17,700 after 2 days, what will happen to this open interest chart? You'll see that this 17,600 open interest will reduce and people will start shifting this position all the way on the upside to maybe 17,800, 17,900. And these shifts tells you that call writers, or maybe I'm explaining with calls, the same concept will apply for puts also. But in this case, if this kind of shifts are happening, that one open interest which is in the money or one strike which has went in the money, open interest is reducing there and it is getting shifted to all the other strikes, it basically means that the call writers are no more in control and they have started losing money. So as a call writer or maybe as an option writer, obviously they will not get trapped on both the legs. Option writer will only be trapped in one leg, either in the call sold leg or in the put sold leg. So in this case, with my example, what I'm trying to explain is if the market is consistently going up and if shiftings are happening from the lower strike calls to upper strike calls, is a kind of an indication that writers are trapped and they are not able to make money. So if I can detect that kind of a data point, then I can know that positionally, maybe Nifty is very strong, or maybe positionally we can look at the same thing for Bank Nifty as well. But positionally, maybe Bank Nifty is strong. And that is the clue which we can derive from the open interest data, whether my positional view is bullish or not. Right? So if I just look at maybe the Bank Nifty data for the same thing. So this is the Bank Nifty open interest, right? So if you see this very classic example, now because I've explained to you, I'm sure you'll be able to read this data now better. Because the Bank Nifty has went up, you can see that all these in the money strikes, which once upon a time it was out of the money, but now because the Bank Nifty has went above that, you see reductions are happening in these open interest, in this case at 38,000 and 38,200. And those open interest are getting shifted where? To 38,300, 38,500 on all the upper strikes. These open interest are shifting. So till the time you see that writers are shifting their strikes consistently on the upside, is the time when the market is telling you that option writers are no more in control and they are kind of losing money, right? So what the trap indicator does, so I'll show you what the trap indicator is. If I just go in the application and just type trap indicator, so you can see that this is the first screen where all the signal comes. I'll explain you this thing. But basically what this tool does is that across the instrument, all the FNO instruments that we have, so all of the places wherever we have derivatives traded, it goes and takes the option data and sees where these kind of shifts are happening, and it concludes that that whether a call writer or a put writer is trapped or not. If there is a scenario that there is a writer's trap happening, will give you kind of a positional idea that this thing is now good and it is making money. Right. So let me give you one example of, let me first explain you what this first page is all about. In this first page, what we can see is it clearly tells you that there's a call writer trap, which is a new trade that has come today itself on Tata Motors at the current market price. Okay. And this is just opened. This is the trade that has come today. if I just scroll down and look at a few past trades, we can also see that there was a call writer trap in LNT on 8th of August at this price of 1857, and that is still open. And this thing, okay, so the signal price was 1834. Today the price is 1857, and it is making around 1.2% return. This is marginally in profit, marginally in losses, because these are just one day before the trades came. And in some of the cases, you'll see that more than 2%, 3%, right? These trades are already, these are all open trades right now, right? So in whatever your favorite stocks are, you can see that if there is an opportunity. So if you see Indus Towers, there is a 5.74% return from the signal. Then all the stocks, you can just scroll it down and you can see. So like IDFC First Bank, there's a 6% return. Adani is a 6% return. JSW 4.5. So depending on what we want to exactly trade, this is identifying where are those areas where these kind of shifts are happening, and you can go and build a trade, right? So my interest will be more on Nifty. So let me open the Nifty chart and let me explain you in more detail how it looks like. So if you look at the Nifty chart now, so this is the kind of a chart that we plot where if you see in this chart, there are three colors. The first color is green. If it is in green, whenever it came in green is basically the time when the indicator is telling you that you should be buying. Whenever it is in black, so you can see that a lot of areas in the chart is the line is black. So if it is black, then it is the algorithm is not able to detect whether there is a call writer's trap or a put writer's trap, and there was no indication, right? So it is a kind of a no trade zone. And whenever you see that these are in reds, then those are the time when the indicator is saying that there is a put writer's trap, which basically means that the put writers are not trapped, so the market is going to go down, right? So if you look at the historical data around this level, the Nifty was at a buy and it exited at this level. Then there were some small trades, marginally positive. Then you can see that there was a marginal loss in this trade. Then again, on the short trade, there was a good profit. But the better way will be, so if you look at the recent data, the sell trade made a good profit. Then again, there was a sell trade, there was a buy trade. So if we can, what we can do is we can directly look at the table on the right-hand side. And this table is showing you all the past signals that we have received with this kind of a behavior where either the call writers or the put writers have been trapped. So if you look at Nifty, there was a recent signal on 29th of July, where the entry price on Nifty was 17,212. And at that level, the algorithm was able to detect a pattern where all the call writers were shifting their positions very aggressively. And even till now, we have that kind of a situation where the call writers are trapped and they're consistently shifting their position. And that is why it is showing that the trade is still open and it is already making about 2% return in this signal. If we see a signal before that, 15th July, there was a signal on Nifty at 16,074 and the exit came at 16,722. That was about a 4% return. If you see before that, again, there was a marginally profitable trade of 0.15%. Then again, before that, it gave a sell signal because it says the put writer's trap on 10 June at 16,200 and then it covered at 15,400, which is about a 5% return. Then again, 5% return. There was a 3% loss. And if you keep scrolling down and look at the accuracy of this kind of a model, let me give you a very quick summary on the kind of accuracy that we have seen. So about 35% of the trade, you'll see that it will come today and it will exit on the next day. And I'll come to this topic in some time when I explain how open interest behaves, and I'll explain you how end of the day things might change. So I'll come to that topic as well. But 35% of the trades out of the trap indicator will be where a trade will come and it will exit at a very marginal profit or a very marginal loss, right? So it will be a no profit, no loss kind of a situation that most of the trades will exit. 35% of the trades precisely will exit. And out of the 65% trades, which will either move up or either move down, if I just look at the historical data over here, there's only a 1-3% losses. Otherwise, if you see, the max loss is about 1.5 in this case, 0.3%, 0.6%, 0.85. So you don't see a lot of losses, and even if there is a loss happening, if I just take a median of all of that, I can conclude that the losses were restricted to about 1.5% on an average. Whereas if you see on the profit side, this trade is still open, but the previous trade 4%, 5%, 5%, 1%, 3%, right? 1.2%, then again 1.5, 4%, 2%. So if you see, all the profits have been far better than the kind of losses. And if you see on an average, even if I safely conclude that about 3% average on up signal basis, basically means that it is a 1:2 reward to risk with a fantastic strike rate is what this model has been. And this is all live. This has been there for a very long time. And it has been able to deliver kind of 1:2 as a reward to risk in terms of at least the signal. I'll explain where option comes into picture and how we can convert this trade into an option. But core model, if you look at the trap indicator as the core model, we can see that you see fantastic amount of signals that comes even on Nifty, Bank Nifty. You can do the same thing on stocks also. So if I just maybe type Bank Nifty in this case, then we can see even on Bank Nifty, there was a trade on 29 July at 37,581. That is still open, making 2% return. The previous trade had 3.6% return. Then again, about 4%, 6%. So the same thing also applies to Bank Nifty, where the losses are restricted to about 1%. And on the upside, you very often you see 3-4% kind of a trades also coming in Bank Nifty, right? So you can maybe go and do this for yourself. Any stock of your choice. I have looked at this indicator for a very, very long time. Any stock you can go and pick of your choice. And this entire theory that whenever the writers are trapped, makes a decent amount of positional signals for people who are tracking something like this. Now let me explain you a few. So I'll come to how we will take this trade, how we will convert this trade into options. It will be simple. I'll just show you how, if we take an option trade on this, what happens. But before I get there, let me explain you how the open interest data itself behaves. Okay, so if I go to chart, and let me open maybe a chart of Nifty. Okay, so what I'm doing is I'm just opening the chart of Nifty. And if you see this, if I plot a 5-minute chart on Nifty, right? So I'll just remove this layout of mine because I don't need it. And I'll add open interest instead. Okay, so I want to look at open interest. So on the lower panel, what I've done is I've just added the open interest data. So I'm just giving an example. Might not be that something has happened today itself, but let me just make this a 5-minute chart. And what we can see is that if I go back and if I look at the 8th August closing, right? So this is approximately 8th August closing, right? So you can see this was 8th August closing. And what is the open interest level? The open interest is at 13 points. So on this side, you can see what the open interest was. I'll just put the cursor again. On 8th August, the open interest is at 13.295 million. Okay, and this is on the intraday data. So the last packet that we received from the exchange had the open interest of 13.295 million. Whereas if I go to the daily data, what happens is the moment I say daily data, it takes the open interest from the end of the day file that the exchange sends, right? So the end of the day file is basically known as bhav copy. So if I look at the last data point, which is this is the 8th of August. What is the open interest that you see there? It is 13.053. So sometime back we saw 13.29 something. Now same day, end of the day, we can see that it is 13.053. So both the numbers does not match. So what happens is that whenever I'm just showing you for futures, if you go and look at for any options or any derivative instrument, the same thing will hold true, where whatever open interest you receive at 3:30, when the market closes, after that exchange does all the processing of the orders and the clearing corporations also comes and clears all the trades. And then a final bhav copy is released by the exchange. and then the open interest changes, right? So during the day, there might be situations. I'm not saying that always there will be a significant amount of difference, but there's a good possibility that during the day, you made a model which is based on open interest, and you did all your analytic and you finally decided, okay, this is the trade I want to take. But what happens is when the market closes, then you see that the open interest itself has changed, and whatever your analytic was, that is no longer holding good. So any model that you base on open interest, you can still use intraday data. I'm not saying no to it, and the strap indicator will also work on intraday data. And during the market, it will be absolute real time. It will keep showing you what the trades are. But you should remember that any analytic that we do on the open interest data, there's a possibility that after the market closes, there's a possibility that things can change because the open interest data itself from the exchange can change significantly. So my best way of how I use the trap indicator will be that when the market closes around 5:30, 6 o'clock, 6:30 is when typically you see the bhav copy coming, right? So any which ways, what you can do is on the next trading day. So let's say tomorrow is the trading day. So tomorrow morning, if I look at this data, that will be most accurate because then all the end of the day bhav copy has come and the analytic that we have is updated now, and it tells you the true signal that this is the final signal that we have. So if I go back to the trap indicator, so this thing, if let's say if the bhav copy is not updated for the day, and if you're looking at this data, then you might have maybe Tata Motors as a buy signal, but the moment the bhav copy comes, and if the open interest changes, if it changes marginally, may not be that Tata Motors will go out of the list, but if the open interest changes significantly, which is not in our control, then you might see that, this went off the list after market, right? So the best time to look at this data will be tomorrow morning before the market opens. You see what the data is, you know that that is the data and it is not going to change. And then on the next day morning, you go and take that trade, right? And the best time to take that trade will be not at 9:15, because at 9:15, when the market opens to about 5 minutes more, you'll see that overnight theta will decay, right? And you'll see that the premiums will tend to go down. So the best time to take this trade will be basically at 9:20 tomorrow morning, when we know that the option premiums are kind of adjusted and the theta decay has already happened, right? So let me summarize what we have learned so far. As an option buyer, you make money when option writers lose money. How will you know that option writers are going to lose money? You will know when from the writing data or from the open interest data, you see that shifts are happening. Okay, it's not a straightforward formula. So we have an algorithm to go and detect that kind of shift. I'm not talking about just one strike, but the entire chain shifting consistently, right? So if there's a pattern like that, then the algorithm of trap indicator detects it, and it tells you that there's a call writer's trap on Nifty, which we saw right now. And if that is the case, so if I just go back to the Nifty screen again, if that is the case, then it tells you, okay, there is a possibility of a call writer's trap and this trade is still open, and it gives you a signal that you can go and participate in this, not on the selling side, but on the buying side. As an option writer, maybe you should look at this data and not write options or not write call options, at least at the times when the trap indicator is suggesting that there's a trap for writers, or maybe you want to place your call writing very far away, right? So this gives you a very clear signal, and historically we have seen that no matter whichever stock you want to try this on, you can go and just try this, and you will see that most of the stocks will have a decent size of signal and a decent kind of a reward for risk also, which in this case we have seen for Nifty, Bank Nifty, at least it is 1:2. In some cases, it is even better than that, right? So we have reached the stage where we have the signal from the trap indicators. Now comes the next point, that after we have the signal, how do we convert it into a trade? So obviously you can do a lot of stuff when it comes to buying options. You can do a long call, you can do a bull call spread, a butterfly, a ratio. There's so many possibilities. And the best way to trade will basically be that I start with a long call and then I keep modifying the strategy depending on where we are placed in the theta curve. But that's a bit complicated for a newbie to come and do. So what I'll do is I'll just go and see that if we just take the same trade with a very simple call option, how does it behave, right? So what we can do is we can take the last signal, the previous signal that was there on Nifty, which was on 15th of July 2022, and the exit date was on 22nd of July 22. So let me just note this down on Excel. So 15th of July 22 was the entry date, and 22nd of July 22 was the exit date, right? So if the entry came on 15 July 22, which means that the entry came at end of the day, when the market closed and the final bhav copy came, everything is done. So when will I take the trade? I'll take the trade obviously on the next day morning. So what we can do is we can try this trade out and we can see how in real life we will be able to go and take this trade. So what I'll do is I'll go to trade recap, where I can go and live this trade of how it behaved in past. So I'll go and select the date, which is basically July. I'm going in past and making that trade, that exact signal. We can go and see how it had behaved. So if you see 15 July, when the signal came, it was a Friday. Obviously, I cannot take a trade on Saturday or Sunday. So I will take my trade on 18th of July. What time? So I want to take my trade at 9:20 a.m. Why 9:20? I just explained you that when the market opens, you should give it 5 minutes for the premium decay and the theta decay to happen. Once that happens, then we can enter that trade that came a day before, right? So at 9:20, I'll just set this, and then I can see that I get all the expiries that were existing at that point of time. And if I'm doing a long call, generally, for a long call to perform better, you need more time to expire, right? And that's the reason that whenever I'm taking a positional trade like this, I cannot take a weekly option in this case because the trade itself might be there for 7-8 days, right? So I should always be taking a monthly option. So if I see 28 July was the monthly option at that point of time when the signal came, so I'll choose that as the expiry. So at that point of time at 9:20 on 18th of July, the futures of Nifty was trading at 16,191.6, right? So what was the ATM option at that point of time? It was 16,200. So if I keep it very simple, and if I say that I'll just go and buy ATM option for Nifty, right? So which is the ATM option? 16,200 calls. So you can see these are calls on the left hand side, 16,200. So I can just say that I want to buy this, okay? And I'll just click on save. So maybe I'll just keep it one lot as it is. And obviously you can do 10 lot, 20 lot, whatever you want to, but I'll just keep one lot so that we can see what is the kind of signal that we have and what is the kind of returns that we can make on this. So I have initiated my trade on 18th of July at 9:20 a.m. At that point of time, the call price I'll buy from us. So the price was at 176.65 and I bought one lot of call option at that point of time. Now, when was my exit? If we go to the Excel, my exit was on 22nd of July, which basically means that when the market closed on 22nd of July, then a next day, one day post that, I'll go and take that trade, right? So I'll just go to point in date and time. And when the exit signal came on 20th, which means that I'll exit on 21st at 9:20 a.m. Maybe I can do it at 9:15 also, but I'm just keeping it very simple. You can obviously the exit trade, you don't want to wait and you want more premium to be there. So you can do it at 9:15, 9:20, whatever the price is. But right after the market opens, right? So we can see that now we have set the algorithm that you go and all the application that you go and scroll all the way to 9:20. Okay, I think I made a mistake. The signal, exit signal was the 22nd. So I will have to go. 23rd was a holiday. So we'll have to go on 25th, right? Because 23rd is Saturday, 24th is Sunday. So I'll just go and say 25th because 22nd was the exit signal, not 20th. I just misread that. So we can see that if we exit that trade on 25th, which is next day when the signal came at end of the day, that you have to exit this trade, then on the next day morning, if I go and exit, then on a per lot basis, there's a return of 16,055, which we saw that in the case of futures, it was about 4% return. But in this case, if we convert the same thing to options, then it is a 16,000 rupees profit. So what is the kind of ROI that we are talking about? That was the premium 176 multiplied by 50. So my investment was 8,800 and the profit is 16,055, right? So by this is the beauty of options. If I take the same trade in options, I make how much? 182% return on that signal. With just one lot, I can make 16,000 rupees profit. Obviously, if you take 10 lot, it could be much higher in terms of absolute profit, but the return percentage is going to be the same. So 182% profit in just a span of a week. So 4% return on the underlying in options basically means that you will go and make a much higher return, because obviously options are non-linear in nature and it will give you amplified returns. So if I just go back to the application and if I go to the trap indicator again, okay, and if I just simulate a few one or two more trades of how it has behaved. So if I just open the Nifty chart again, and if I see what is the open trade doing right now on Nifty. So on 29th of July, there was an open trade at 17,212. So instead of buying futures, obviously we want to do an option on top of it. So we'll just go to this app, this thing again, and I'll just reset it. And 29th was the signal. So I'll say that when will I be able to buy it? So 29th was a Friday. Saturday, Sunday we cannot trade. So we'll go to 1st August. And 1st August at 9:20 is basically when I want to go and take a trade, right? So at 9:20, I'll just set this. And then I get the expiry. I'll select the monthly expiry, because that is, if I'm buying a call option, I need more time to expiry. So I'll go and buy a monthly option. The Nifty was at 17,215. So the ATM call option is at 17,200, which was trading at 292. So I'll go and buy this. And let's just save it as it is. Or maybe if I just make it 10 lots this time, if I buy 500 quantity, this is what the trade is. When was the exit of that signal? So there's no exit because the trade is still open. So if I see what was the return till 8, maybe last trading day, at around market closing, so 15:30. What was the return till the last day? Today, obviously, the return would have went up because the market has went up. But this trade recap will get updated by end of the day. So it takes some time. So for the day, it is not updated yet because this is the kind of past data. For the today's data, you can go to architect and you can see what the exact payoff will be. But you can see in the open trade that we have, had we bought 10 lots of the same thing converted to option, the mark to market is, even right now, it is 79,000 rupees in profit, right? Now, not always you'll make money. So let's also talk about risk, that what happens if I take a losing trade. So maybe what we can do is this time we can just go to BankNifty also and give it a shot. So let's say in BankNifty, in the last signal, obviously it had made a similar kind of return that was there in Nifty. But in BankNifty, let's say if I happen to take, or maybe let's evaluate one of the trade in BankNifty, and then we compare it to the losses with BankNifty as well. So the last signal on BankNifty was on 18th July and exit was on 22nd July. So if I just reset this and if we take a trade on BankNifty, so we'll not be able to take a trade on 18th. So we'll be able to take a trade on 19th because next day is when we will go and enter the trade when the market opens. So we'll be trading the monthly option. And I'll just do the same thing where we are talking about buying the ATM call option, right? So we'll just buy this call option and we'll save it. When was the exit? The exit was on 22nd of July, right? So we'll directly go to point in time, and 22nd was Friday. So we will be able to exit this trade on 25th at around the market opening time. So I'll just say 25th. And on a per lot basis, if I see what kind of a profit that signal would have given me, then we can see that the profit was 31,427, right? So let me just write this down on Excel. 31,427 was the profit on Bank Nifty on a winning trade. If we look at one losing trade as well, that in this we can, if you scroll down, most of the trade in Bank Nifty were winning trades. You can see 2%, 3%, 3%, 5%. But if I take this trade, which is the highest loss that I see over here, on 5th of April 2022, there was a buy trade on Bank Nifty, which eventually lost money. So let's see if this kind of a situation happens with me, then how much do I lose, right? So on 5th of April, so we will just go to this. Let me just reset this and let me go all the way to April. So 5th means that we'll go and take a trade on 6th at 9:20, right? So let me set this, and we will be taking a monthly expiry. So if you see the prices around that time for the monthly expiry, the Bank Nifty was trading at this level, and we will be buying a ATM call option, right? So I'll just go and save this. And when was the exit for this trade? The exit was on 13th of April, right? So I'll just go to point in time and I'll say the exit will be on 14th in morning. So on 14th, if I go and see what happened to my trade, then I can see, okay, 15,000 rupees, 15,406 is the loss. So minus 15,406, right? So in a winning trade on Bank Nifty, this signal made 31,000 rupees profit. And on a losing trade, it made 15,000 rupees losses. So even if you look at the reward to risk, and this is the highest loss that we could find. There were very few losses, but the highest loss. So the reward to risk is still 2:1. So if I go back and if I look at this table, there are very less losing trades that you find. And even if you take the highest losing trade on the signal that we had, still the amount that you lose in this is very small compared to the profits that you make, right? So in this way, let me summarize what we have learned, and then maybe I can take a few questions and answers also on this. So one of the, I think, one of the best things that we have invented in the recent time out of the research that we keep doing all the time, one of them is trap indicator for sure. And for option buyers, it is important to know that when are writers going to get trapped and when can writers lose money. And to detect that is not a very easy game. You need a very sophisticated system to go and detect it. There would be many ways of doing it. I'm not saying trap indicator will be the only way to do it, but obviously in the algorithm that we have made to detect the shift in the price is working for us for a very long time. This has been around, and you can see that the signals are already there, and it is fairly ready-made where you have the signals immediately there. And then all you have to do is just look at those signals and then just take a very simple, if I just do as simple as just buying a call option or buying a put option, still I can see that the returns are phenomenal, and at least a 2:1 strike rate is, or reward to risk is what we can talk about. So this way, constructing a positional system is fairly easy. And you can just try this out with trade recap of how the signals have happened in past for your favorite stocks. Let's say if I like trading maybe L&T, okay, just for instance. So if I go and look at L&T, fantastic returns, right? 5% in this, 8% in this trade, 2%, 5%, 2%, some very small losses, then 7% return. So any stock that you want to trade on, you can go and just check what were the signals in past. And then you can also live that trade with trade recap, where you can see how much was the profit or loss that you could have made. That will give you more confidence. You should always try out your systems, and then you can start replicating these trades in your positional trading books. So I guess that's all from my side from the trap indicator for today. And you will obviously find trap indicator in the Quantsapp web application as well as the mobile app, where you can see all those signals and you can take a trade directly from there. So any questions on the trap indicator, I can take that up now. So I can see a lot of questions. That's good. Okay, so the first question is, sometimes it happens that prices are moving up and call writers are increasing their position in the same. In that case, where should we keep our position? Okay. So since the trap indicator is kind of ready-made and it will automatically detect that situation for you. So obviously it will not give you a trade if something like that is happening. But just to explain you from an open interest perspective, if the market went up and the call writers are stubborn and they are not moving at all, there could be a good possibility that they will defend that level and the market might find it difficult to cross that level. But that also makes it more vulnerable that eventually if that level is broken, then you might have a very big breakout also happening, right? So you cannot call it for surety. So my trade, or as a trader, I will not want to preempt anything. I will wait. If the call writers are defending that level, I will not enter the trade. The moment I see that call writers are no more able to defend that level and the prices start moving beyond that, you can go and watch the videos that we have on triggers because that is the same concept. But if that kind of a situation happens, then I will say that I'll go and buy. So I'll not preempt it. I'll keep waiting till the writers are defending it. And then later on, whenever that level is shaped, then it will be a buy for option buys. Okay, so the second query is call writer trap means bullish and put writer trap means bearish. Could you confirm? Yes, so that's exactly what it means. A call writer trap basically means that the call writers will be trapped, which means that the overall movement is bullish. And let me explain you where it originates from. So because nowadays when we say that options volumes are 90% and majority of the volumes are happening in options. So if the option writers are trapped, it will basically mean that the future price will go up. It is also the other way around. It's not that options are dependent on futures. If most of the value is getting traded in options, so eventually even the futures will behave like options, right? Along with options. So it cannot be that options are moving and futures will not move. So in these cases, when you see that options have a very high stake, then because of those movements in option, you'll see futures moving. And that is why we are able to take a trade only based on what the option writers are. Okay, so the third query is how to identify stop loss and trap. How long are the positions to be taken for options? What about the theta decay? Okay, so that's a good question. So first of all, if you look at stop loss, the best way will be that whichever stock you want to go in trade, go and look at the past data of how the signals have been. In most of the cases, because of the kind of terminology that we are trying to trade in the signals, which is talking about shifts, the moment that shift stops happening, you'll immediately see that that signal moves out. So this system, historically we have seen, does not take a lot of risk, which basically means that if it enters today and if it sees that tomorrow this shifts have stopped happening and reverse are happening or maybe it just stops happening, it immediately takes an exit. And that is why 35% of the trades, you'll see that it came today, exited tomorrow, only because it might just reach to that level where option writers are kind of getting busy. And then you might see that, they took ultimate control and they defended that level. So 35% of the cases will happen when the trade will come up today and then it will not cross on the next day and it will tell you to exit. But that is the beauty of it, that you don't have to wait for a stop loss of 5%, 10%. And normally we have seen that the stop losses are very, very small in most of the cases. Now coming to the second point that was asked about the theta decay. So I'm not saying that long call will be the best way to do it. Obviously, the best way will be that you start with a long call, convert it into a vertical spread, convert it into a butterfly, convert it into a ratio. But you need to have that knowledge of how strategies work and how and when to convert those strategies will depend on how the theta curve is. So if you know that, you can certainly do it. But if you don't know it and if you want to keep it fairly simple, then even doing a long call, we have seen that historically has also been giving a decent reward to risk of 1:2 at least. But you could also do something like going and putting that trade in optimizer. You can watch videos on optimizer of what it is in the application, where you can put that signal and you can get the best possible option trade on that signal. So the next query is, if we buy monthly positional on signal, which option to be bought? Okay. Should it be ATM, ITM, or deep ITM? So that's a matter of preference. Since I want to make money from the non-linear nature of options, what I need to know is that if there is a writer's trap, means that the movement is going to be very fast. Okay, and if the movement is going to be very fast, then what is the Greek I'm trying to make money from? It is called gamma. And if you look at where gamma is highest for ATM option. So if I have to go and take a trade, I will go and take a trade only on ATM option, which will have the highest gamma, which basically means that I will make the maximum amount of profit. In general, I'm saying as the best approximation, I'll make the highest amount of profit from fast move in ATM option. So my choice will always be to go and take a ATM option. Okay, so fifth query is that, is there any particular time to take the trade by option or not to take? Likewise, start, mid, or last of the month. Okay, so if let's say if I'm trying to take the monthly option, but it is only 3 days left to expiry or 4 days left to expiry for the monthly option, then obviously that is not good enough time, because the signal might itself be open for 7, 8 days, 10 days, we don't know, right? So if time left to expiry for the monthly option is very small, then the best case will be that you go and take the next monthly option. So in general, I would say that at least there should be 10 days left to expiry if you are taking that trade, or if it is, let's say, only 4, 5 days left to expiry, then take the next monthly option, because in the longer the time, lower the theta decay. That's how the theta really works. Longer the time, lower the theta decay, or slower the theta decay is what you can call correctly. So that's why if you're buying option, you want more time to expire. So always try to take the longer option, which could be the monthly option. And if the monthly option itself is now very nearby, then take the next monthly option. So that's all. I think we'll keep it till there. I hope that today's webinar adds some value of how you can use trap indicator better for positional trading, right? So let me just summarize it very quickly. You can, all you have to do is, as an option buyer, you need to detect when writers are going to lose money. That can be detected if you can detect that shifts are happening. Trap indicator does the same thing for you. It detects where the shifts are happening and gives you very clearly stated signals. And on those signals, what I can do is I can just go and deploy option strategies. I can do a long call, long put also, to keep it simple. Otherwise, if I know more terminologies, I can convert those strategy and evolve it eventually, which can give me even more higher returns than what we saw. And if I just keep doing that, fairly simple to execute, all you need is maybe 5 minutes, 10 minutes in a day. If you can just afford that, then you already have a system which is working absolutely fine, at least as of now, in the past 2-3 years of data that you see. And this logic has been there for a good amount of time, but in the application, you can go and see all the past trades and you can see if that makes sense for you. So thank you very much for joining me today. And I'll just appreciate if you can maybe comment on whichever platform you are joining on about what will be the next webinar, or what would you like to learn from me, because I just recently started doing webinars and I was never into it, but my team said that, I should be interacting with some portion of it, right? So maybe you can just comment and tell me what will be the next topic that you would want me to speak on. So have a great evening and thank you very much for joining today.